lot of people are thinking that what happened when COVID went down like 34% in 19 days is that it was a price dislocation in the stock market. It really wasn't the crash that everybody was used to seeing. It was just like a price dislocation, which was kind of strange. And so that's why maybe it snapped back, because the actual price of what they were seeing was not actually the real price. But with that being said, let's go into some numbers about how often does a bear market actually happen?
Well, the average bear market loss is 35%. Okay. The smallest loss was 21% all the way back 1949. But the worst was 62% from November 1931 to June 1932.
And we all remember 08 to 09.
And that was 54%.
From peak to trough, from top to bottom. Although if you look at the published number for 08, it would tell you that the market went down 37%. That's not looking from the top to the bottom.
Exactly.
The top being in 08 and the bottom being, I think it was March of 09. That whole stretch of time, it was down 54%, a little over 54% at that point in time.
So remember, they just were talking about 20% or more losses. Those are the bear market, the market crashes, right? Those are 20% or more downturn in the market. A pullback is 5 to 9%. Those happen typically 3 or 4 times every single year. Corrections are a 10 to 19% downturn, and those usually happen every year or two. So it's kind of depending on what you're talking about. A correction, 10 to 19%, crashes 20% or more, pullback under 10%, but the market's going down a little bit. So Group 10 Financial has been around for over 60 years. So you've almost 60 years. So
coming up on it.
Yeah. So you've seen many market crashes over the years. Do you find in general that most Americans are prepared for market corrections or crashes?
Most aren't ready at all. They get scared and cash out when the market's in the cellar at the bottom and never get back in. A lot of people, Mark, are still in cash since the crash in 2008. People get emotional and break one very important rule. They don't follow math over emotion.
And that's hard to do. It's hard to follow math over your emotion because we're emotional creatures. So what people should do is have a system that follows math, and that math helps manage their money. And when the math shows that the market is calm and rising, you invest. And when the market is showing abnormal volatility and is no longer calm, then just like a circuit breaker works on your house, a switch is thrown and the money is moved defensively. That's using math, not emotion. But honestly, these are strategies that very, very few people use in their portfolios. And these should be the centerpiece of a solid financial plan. And if you want to know how you can use these strategies with your money, just give us a call and I'll give you that number out here in a second. But another thing you should have done is a stress test. And we talked about that before. Just like going to the doctor, you get a stress test to see if you are healthy or not. You can do the same thing with your portfolio. You can take all your investments, scan them like you would if you go to the grocery store and you scan your cart. We can scan the items that are in your financial shopping cart and tell you exactly how much money you could lose if we have another market crash, like an 08 market crash, or if we have another COVID market crash, or if we have interest rates that spike. What's all this look like? And there's a lot of other scenarios that we can look at, but the stress test is at the core of what is our on-the-money retirement blueprint process. And if you want a stress test done for you at no cost, our team can do that for you. Just give us a call in the next 15 minutes for this virtual strategy session, and we'll do that stress test for you, and we'll walk you through that. Mark, how can people do that?
Yeah, the number is 800-691-3372. Again, there's no cost for this. There's no obligation. 800-691-3372. You can also text the word retire to that same number. Call or text the word retire for your 15-minute virtual strategy session with the Group 10 Financial team. Again, it's 800-691-3372. Glad you're with us today for On the Money with Jerry and Nick Roy with Group 10 Financial. I'm Mark Elliott. All right, let's talk about diversification, because I think most people maybe think they're diversified because they've got 30 different mutual funds. So I'm diversified, but it's all in mutual funds. So do people understand diversification? Do they understand, because if you're properly diversified, you maybe can withstand some market corrections and crashes when they happen. But if we don't really understand, so first, let's talk about diversification. Kind of explain it to me, if you would.
So diversification, and let's face it, market is going to ebb and flow, and that's what it does. The market's going to go up 10%. It's going to go down 10%. The market's going to go up 15%. It's going to go down 15%. And that's pretty normal. What's not normal is when the market is down 30, 40, 50%. That's unusual. So you had used that word, quote unquote, diversified. And most people are using what we call standard diversification. That's when instead of investing in one stock or one mutual fund, they invest in 15. But Dad, where is a stock sold? Where is a mutual fund sold?
It's sold in the market, which means you have basically dollars that can go up and dollars that can go down.
So traditional diversification is where you have a whole bunch of these things, but certain ones will go up at certain rates and certain ones will go down at certain rates. But typically they all go down at the same time.
Yeah,
just different ways.
Yeah, diversification would be having some money in all categories. You have money that are safe, they can't go down regardless of what comes out of Wall Street, and you have money that is in the market. But you have to have a combination to have a solid diversification.
But what you're talking about is true diversification, which is different than standard traditional diversification that was been taught to me when I went to college, and they just said own 15 stocks instead of one.
How many times people will have 8 or 9 different mutual funds, and when you come in and you look at when there's a stress test ran, and you see where in that mutual fund they're invested, they all have Disney. They all have. Yeah, they're all in the same category.
Overlap.
Different company,
right.
but still in the same investment.
So certainly we've heard about diversity for a long time and being able to diversify our monies. And as you said, Nick, I mean, the old way is just, you've got 15 stocks or 15 different mutual funds, but they're all in the same kind of category. So that's a challenge. But diversification is a key, as Jerry pointed out. It's not being all in the same place. Your money's in different places. What else beyond diversification can someone do to help protect their money, but still get some decent growth on their money?
So if we were to call level 1 entry-level investing diversification, that would be investing like we had just talked about. Don't invest in one stock, invest in 15, or don't invest in one mutual fund, invest in 15, whatever. That's what we would call level 1, entry-level diversification. Let's kick it up a notch. Let's call the next step up level 2 investing, where you integrate in alternative investments into your portfolio.